Welcome to the Paragon Financial Partners Podcast, where we discuss the markets, our strategies, and how to live better today while planning for tomorrow. Hello, and welcome to the Paragon Podcast. I'm Elian Mendoza, and I'm here with Evan Shorten, the firm's founder and principal.
Hello, this is Evan. I hope you're doing well and staying healthy. I want to thank you for tuning into the podcast and encourage you to subscribe via Apple Podcast app, Stitcher Radio, or our YouTube channel. Finally, to stay up to date with all of our content, please sign up for email alerts using sign up on our homepage at paragonfinancialpartners.com.
Okay, so we know the financial crises stemming from the COVID-19 fallout has led to a lot of one-off changes with regards to retirement plans in 2020. Most notably, the CARES Act has created some unique options that older investors may find appealing. Mainly, most required minimum distributions, or RMDs as they're normally referred to, have been suspended for this year, 2020. Normally, you must begin taking RMDs once you reach the age of 72 for a traditional or rollover IRA. If you inherited an IRA, you're generally required to begin taking RMDs soon after the original IRA owner passes away. For 2020, if you have an IRA or an inherited IRA, you don't have to take an RMD this year. And therefore, you don't have to worry about any penalties associated with missing any RMDs. And if you're wondering why we're not mentioning Roth IRAs, it's due to the fact that Roth IRAs don't have required minimum distributions for the original owner or a spousal beneficiary. So this presents some retirement planning benefits that you can take advantage of this year. Evan, do you want to take things a bit deeper?
Sure. The first benefit for retirees, and probably even more so for inherited IRA owners, is an added year of deferred growth to the IRA. Simply, it's an extra year of compounding for your IRA, and depending upon the size or dollar value of your IRA, this can be a sizable boost. To give you an idea, for larger accounts of $1 million or more, this could be in excess of $25,000 of reinvested dividends and or interest. The second benefit, and the one that may be felt more in your wallet, is a lower taxable income for this year. Distributions from traditional IRAs and inherited IRAs are taxed as ordinary income. And if you have a sizable IRA with larger required minimum distributions, you've most likely noticed the tax bill associated with your annual distribution. If you don't need the income from your IRA this year, foregoing your 2020 RMD can help lower your income tax liability and is worth discussing with your financial advisor or tax professional.
And just as a reminder, we're specifically talking about traditional / rollover IRAs, as well as inherited IRAs, which are sometimes referred to as beneficiary IRAs. We're not talking about Roth IRAs or inherited Roths, because when it comes to ordinary income tax, qualified distributions from Roth and inherited Roth IRAs are income tax free.
Yes, thank you. Now to expand on the point about lowering your taxable income by foregoing your required minimum distribution this year, you may be able to lower your tax liability even more. If you normally donate your distribution, your required minimum distribution, to charity through what's called a qualified charitable distribution in order to exclude your required distribution from your taxable income, you may be able to get a greater tax benefit this year by donating cash instead of your RMD. For example, by foregoing your RMD this year, you're already lowering your taxable income. If you proceed with your annual qualified charitable distribution, you might want to donate cash, appreciated securities, or securities with no cost basis as a way to help offset your tax liability from your other income sources. Again, this is a strategy available to you this year, which may be worth discussing with your financial advisor or tax professional. And of course, you can always reach out to us. I also want to pivot and point out that this is a great year to convert a portion of your IRA to a Roth IRA. If you do forego taking an RMD, you might consider converting what you would have normally taken as your distribution or a percentage of it and converting that amount to a Roth IRA instead. If you are already accounting for taxes on your RMD, it may be worthwhile to pay the one-time income tax to convert to a Roth, as you'll be creating a tax-free retirement plan for yourself or for your heirs. And it'll reduce your RMDs for future years. Additionally, if the economy continues to worsen and we see another big decrease in the value of securities, it may be worth to convert depreciated securities to a Roth if you believe those securities can regain their value and continue growing over time.
Okay, great. I also would not be surprised if there were more rules changes announced later on during the year. As the fallout from COVID-19 continues, the CARES Act may not be the last major legislation we see this year regarding changes to tax laws. Of course, we'll be here to keep everyone updated and help anyone who may seek our assistance throughout all this. Hopefully, you enjoyed this episode of the Paragon Podcast and you found it helpful. Please subscribe to the podcast on our YouTube channel, the Apple Podcast app, or Stitcher Radio. Thank you for listening.
Yes, thank you, and we'll see you here again soon.
Paragon Financial Partners, Inc. is a registered SEC investment advisor. The broadcast is for informational purposes only and should not be considered as a solicitation or offer to purchase or sell securities. The financial strategies and guidelines discussed herein may not be appropriate for everyone, as each individual circumstance is unique. Please review all tax information with your tax professional. Please review all legal information with your legal professional. We hope you enjoyed the Paragon Financial Partners podcast. And again, thank you for listening.